Okay, good morning everybody and welcome. Thank you for attending this webinar. I think we've just got one or two more people that are going to be joining us, but as with everything, we can't hang around forever, so we're going to crack on with it. So whilst you're waiting, please can you all take note of my contact details which are in the chat. They will be obviously repeated at the end of the webinar, but if anybody needs to leave early, then obviously please take note of them in case you might want to get in touch. So, Charterhouse, we are a top firm of accountants based in Harrow. The practice has been established for over 51 years. We have over 50 members of staff and well over 2,000 clients. We are a professional practice and not a tax boutique offering quick solutions today and gone tomorrow. I've been with Charterhouse now for nearly 40 years and been a principal of the business for at least 20 of those years. I have my own portfolio of clients and head up our finance, our sales and marketing, and I think I know enough about tax to be dangerous. Joining me today is fellow owner and managing director Rajesh Jiwani. Raj is our tax principal, amongst other things, and is here today to see I get things right, but specifically to answer any technically challenging questions you may have. Please do put any questions in the chat. Welcome to this, the fourth Charterhouse webinar in our series, Investment, Property, Taxation and Planning. I assume you're all here because you either have investment property or clients or contacts in that field. Our intention today is to provide you with enough information to encourage you to want to contact us to find out more. Now, you can all help ensuring you ask as many questions as possible. You can do this by posing questions you may have in the chat box. So do please challenge us. If some of you have already raised questions ahead of the webinar, we'll obviously get those addressed too. Now let's get started. As landlords, it must seem as though you are public enemy number one. The raft of HMRC changes has made it much different position for the buy-to-let landlord now. It all started a few years back with the removal of the old wear and tear allowance being replaced with the new renewal basis. Followed 4 years ago with Section 24 changes, which is interest relief restrictions that could see you unknowingly move into the next tax bracket, or perhaps because of the way the tax relief is now given, you could find yourself losing not only your personal allowances if your income goes above £100,000, or indeed losing your child allowances if your income goes above £60,000. Even overseas landlords with UK residential properties are now being caught. Stamp duty land tax changes with regards to second properties and those purchased by corporates all add to that pain. And in an effort to tax the Roman Abramoviches of this world with the ATED charge, this has also impacted on connected family members now living in corporate rental properties, something that not everybody knows. If that was not enough, there has been an awful lot of talk about CGT increasing from its current 28% on property to sit at the same rates as the higher level of income tax, and this could be as much as 45%. Finally, since the 5th of April 2020, if a UK resident disposes of a UK residential property and it is not their main home and they make a capital gain where there is tax to pay, HMRC need to be informed and tax paid within 30 days. That's 30 days of completion. Not much time there. So, do you run your property portfolio as a business and would you qualify for a Section 162 incorporation? Well, this depends on a number of factors, such as the number of properties, the time dedicated to running the portfolio of properties, and how the portfolio is managed, etc. The Elizabeth Moen Ramsey case being the well-known example to which we all often refer. She had 10 properties and worked 20 plus hours on her property portfolio. But having lost her case for incorporation under Section 162 at the lower courts, challenged them and eventually won at the upper court. Section 162 incorporation is normally a given for trades wanting to incorporate their business, but HMRC viewed the running of a property portfolio business a bit differently. HMRC gave up providing clearances on the matter 2 summers ago, although we have never thought that the clearance would be worth the paper it was written on. With a Section 162 incorporation of a property business, you can only exchange the properties for shares. Any cash element would give rise to an immediate CGT charge. All you end up with in the Section 162 corporate entity is a share premium account that you can do absolutely nothing with. Although we may have a solution to that problem as well. Following a Section 162 incorporation, the properties will have been moved into a corporate vehicle and the company will then be able to pay corporate rates of tax, 19%, rather than the personal rates of tax up to 45%. But that is where any benefit stops. The Section 162 planning is simply a deferment of capital gains tax. CGT will still need to be paid on any gain if you ever want to do anything with the shares in the future. The CGT will come back to bite you as the shares are rebased to the original price of the properties without any uplifted value. But it's worse than that, because if you need to take money out of the company, you will also be faced with another layer of tax. Elizabeth Moen Ramsey, having won her case in respect of capital gains tax, did not achieve any relief for stamp duty land tax. And that is why you hear about advisors suggesting the property business is transferred into a partnership, whether it's general or limited liability partnership. As if this is done correctly, this will allow relief against paying any stamp duty land tax. But even with an SDLT benefit, Charterhouse never saw the Section 162 route as the best and most viable route to incorporation for those running a property portfolio business. But don't worry, if you have already incorporated using Section 162 and you're uncomfortable with the position that you are now left with, do contact me for further information on how we might be able to help you get the benefit of the property restructuring I'm now going to talk about. As mentioned previously, aside from the benefit of limited liability, the biggest advantage to pay lower rates of tax on your property rental profits. Currently, corporation tax is 19%, but it is legislated to increase to 25% for profits over £250,000 from April 2023. After this date, the corporation tax will remain at 19% for profits under £50,000, but will increase with marginal relief up to 25% for profits over £250,000. Either way, this is still substantially less than the higher rates of income tax. Currently, loan mortgage interest is a deductible expense in a corporate entity, whereas with Section 24, the tax relief is limited and not treated as a deductible expense. The tax-free dividend, albeit only £2,000, may be a benefit, but if you are a basic rate taxpayer, only paying 7.5% on a dividend might also be appealing. With the changes in the budget, it might also be advantageous for you to operate through a limited company, avail yourself of the new capital allowances regime. Pension contributions have less restrictions and may provide better opportunities in a corporate, but more about that on another day. What if I said to you, Charterhouse have been working on a solution to help you incorporate your property portfolio, residential, commercial, or a mixture of both, for over 7 years now, well before Section 24 loan interest issues, and our solution is something we believe to be much better than a Section 162 incorporation. Would you be interested? With our planning and restructuring, there is a potential to mitigate capital gains tax and stamp duty land tax that might otherwise arise from restructuring your business, and indeed rebase your properties to the current market value in a new limited company. allowing you to pay corporate rates of tax rather than personal rates of tax, and potentially providing you with a pot equal to the equity you have in your property portfolio that would ultimately be available to draw down without paying any personal tax. Would you be interested? I think I might have your attention now, but just in case, let me throw in, by doing the restructuring, we would create a great platform for inheritance tax planning and protect your assets so that you remain in control at all times. Something really very relevant in this day and age. So, what is the Charterhouse process? We will initially ask you to complete a property questionnaire and some simple questions about yourself and your business partners, if appropriate. We will then produce an illustration showing you all the benefits and tax savings I have alluded to. We will encourage you to have a meeting with myself and Raj, discuss the illustration and our property planning in more detail. Please do bring with you your accountant or your financial advisors to that meeting so that they can see it is real and not just pub talk. And of course, they can ask as many questions as they like whilst you're in the room. At the end of that meeting, we will outline our fees to deliver the benefits and the savings, and you can choose to go ahead or not. We will not charge any fees for the illustration or indeed the initial meeting to discuss the planning restructuring. Our solution does involve a limited liability partnership, and specifically the uniqueness and flexibility of its structure when certain events occur. All arrangements are made for good commercial reasons, and nothing is preordained, as you have choices, many choices throughout, and you do have various options to consider into the future. The property business will need to be in the limited liability partnership for a minimum of 3 tax years, 18 months at best, before we can fully review the same for best efficiency for your business. All cases are unique and no solution is the same for everyone. But whilst we can do the planning in certain circumstances for less than 3 properties, it is worth talking to us about your own situation if you do have less than 3 properties. We would suggest that having at least 3 buy-to-let properties would be best. Charterhouse have taken great strides in ensuring that its property restructuring is robust. We've had 4 separate leading tax councils' opinions, all with positive results. If you were interested in our solution, then these would be available for you to look at in our offices in Harrow. We fully disclose the planning at each stage to HMRC, and as such, they have a 1-year window within which to make any inquiry. To date, we have done well over 80 cases, all at different stages, and to date, over 7 years, we have only had 2 cases where HMRC have asked any questions, and these weren't as a direct result of our planning, they were as a result of them inquiring to other aspects of our clients' affairs. We're very confident. As mentioned before, Charterhouse is a long-established firm of accountants and tax advisors with over 2,000 clients, and we would not risk any of that for some wayward planning or tax advice. We offer our clients fee protection insurance, and the insurance company simply sees this planning as normal tax advice without any hike in cost. We will not do this restructuring with any client whose affairs are not completely up to date, with all matters having been fully disclosed to HMRC. That is absolutely important. Lloyds Bank have reviewed the planning, and they are happy to recommend and have recommended cases to us. Other firms of accountants use us because more often than not, the normal high street accountants will not know about the solutions that we have, and as such, will not be proactive in talking to you about this type of planning. So you can see a bit of a barrier there. The property restructuring is not a reportable GOTAS scheme, and neither is it the sort of tax planning you may have heard about involving high-profile individuals in the media. So what are the potential benefits? It provides your business with the benefit of limited liability protection. It creates a flexible structure through which to operate your business. It creates a structure which provides further options in respect of financing, such as portfolio lending. It enables you to accelerate the expansion and growth of your portfolio and therefore increases your profitability. It provides a flexible platform through which you can introduce future generations as part of your overall succession planning. It gives you the ability to retain control whilst achieving your succession planning objectives. Depending upon your circumstances, there is also the potential that advantageous tax consequences and efficiencies will be achieved, which are inherent in the restructuring. A pot equal to the equity in the portfolio is available to draw down without suffering any personal tax. Maybe some of the savings are probably better explained by way of an example. I have picked Mr. Test and Mrs. Example. They have 4 properties, and between them, Test owning one outright and the other 3 equally. Test has other income away from property of £50,000 and Example has £40,000 worth of other income. 4 properties that they own cost a combined £1.325 million and with capital expenditure of £150,000 on each. In total. And having a current market value of £2.375 million with an outstanding mortgage of £1.05 million. Total rental income of £110,000 and annual rental expenses of £11,000 with mortgage interest totaling £31,500. This is all information that we gleaned from you with the questionnaire. We then populate all of that information into our template and provide you with some calculations. I'm going to only show you now the summary page, but effectively you get something like a 12, 14-page document basically that will outline all of the tax consequences. So in our example, the following benefits will arise. There is a potential saving in income tax to corporation tax of £20,175 each year. There is a potential saving in capital gains tax of £278,546 if the properties are sold 4 years later. There's a potential saving in stamp duty land tax of £150,000. And you remember the pot I was talking about? That pot is 1.325 million. It's created with a property restructure that can be drawn from the ultimate limited company without any personal tax. Significant savings, significant benefits through this structure. So to wrap up, connect with us, complete the questionnaire and receive an illustration that will highlight the benefits and the tax savings. If you want to find out more, and if the property restructuring is of interest, do follow up with a free Zoom meeting to go through the planning and your illustration. Don't forget, you can invite your accountant or your financial advisor. It really helps everybody. But right now, the most important thing is pose some questions, because I'm sure there'll be lots of questions out there. And let's see if we can really challenge Raj. Please take note of my contact details and do get in touch. Hopefully this webinar has been informative to you. Hopefully the questions that we will be answering will be informative to you, and hopefully you will get in touch. So thank you for listening. I look forward to hearing from you. I'll answer that one if you like. Raj, you can correct me if you think I'm wrong or you've got a different opinion. I think there's been a lot of talk about CGT rising, as I say, to the rates of income tax levels. And I do think that's pretty real, that might happen. There was also issues talked about previously where there were some thoughts that if there was a change of government, then potentially you might find that that rate will be even higher. And I think the number of about 56% has been sort of mooted around before, so double what it is at the moment. So again, the illustrations that I had drawn up and shown you on the slide were all based around the current legislation at 28%. So you can imagine the damage that will be caused or the extra taxes that will be payable if indeed that rate does go up. Raj, did you have anything you wanted to add to that?
Yeah, I think we all have heard enough in the press about how this government's going to pay for all the support that's been provided during the course of the pandemic. The Chancellor, in his last budget, was trying to leave the country with a glimmer of hope, and so didn't press ahead with lots of tax changes. The most notable one was the increase in corporation tax to 25% from April 23. But I think there will need to be a real conversation taking place in government as to how they're going to plug this deficit, and bringing CGT in line with income tax rates is an easy solution for them, and one that's been tried and tested in the past. So my opinion is that we can't discount that. There's a good possibility that it might not happen now, it might not happen in the next year, but give it 2 years, April 23, when hopefully things are more back to normal, there's a good chance that the rate of CGT will go up.
I don't think it'll be waiting for an autumn statement or a budget, Raj. I think it'll actually come, it'll be suddenly thrust upon us that this is what's happening. It'll be an overnight thing, seeing the revenue do that before. So let's wait and see. Well, hopefully that's answered that question.
So we found from speaking to clients and our third-party contacts who advise on mortgages that generally the gap between the rates available to individuals in respect of buy-to-let mortgages and those available to limited companies and other corporate structures such as LLPs has come down significantly over the past few years, and that gap now is fairly narrow. Equally, there are other ways, depending on the terms and conditions of mortgages, to enable businesses to restructure without necessarily having to refinance. And that's something that people should consider also.
I think they should also look at whether or not they need to be mortgaging within the LLP, because I think that was the question, as opposed to mortgaging properties in their own name and within the structure. And that's something that we will certainly talk to them about and offer our advice in relation to that. I think the answer to that one is that we can't do our property planning as is, just with one property, but depending upon their other circumstances, we might be able to do some planning around that. And as I said in the webinar, that effectively we're looking for people to have, at least a minimum of 3 properties. But really it's what they want to achieve out of the planning is the important thing. So, you could be buying a property straight off now and straight into a corporate. So it's really talking to them about their circumstances. So I would say in any event, 1 property, 2 properties or more, then people should talk to us about planning the way forward, whether it's buying straight into a corporate or indeed talking to us now about how we might help them with a potentially another different structure that they might have depending upon their own circumstances. Raj, do you want to add anything to that?
Yeah, I mean, we've spoken to many clients over the years in very different circumstances, as David says, from people that are considering becoming landlords to those that have 1 property, to those that have got 25 plus properties. And we've always tended to find that we have something worth saying to such clients, and that there's always value added when speaking to them. We can give them different perspectives that they haven't necessarily considered previously. It shouldn't necessarily be a huge shift change. What you will find is that there is certainly more administration involved in running a company. You have various statutory responsibilities, like filing accounts with Companies House and with HMRC, producing corporation tax returns and accounting for money that you've drawn out of a company in a different way in which you've been doing so as an individual landlord. So there is a bit more work to be done, but generally the accountants take care of all of that, and you're left to run your business.
Yeah, I think the important thing just to add to that is that it is a real business that you're dealing with here. So you will need, when you go into the LLP, to open an LLP bank account, as indeed when you move into the limited company, if that's your eventual aim, then you'll need to have a separate limited company bank account. But effectively, to all intents and purposes, there are a few more hoops to go through, but ultimately at the end of the day, you know, the reward that you get, the benefit, the tax savings that you get should more than outweigh that. And I'm happy to talk about that. And as we do with anybody with our planning, we navigate and help them through the issues that they face and the decisions that they have to make, and obviously all the administrative things that they need to consider when following our restructuring.
So the general rule is that when an individual transfers assets to a company that they're connected to, the company is deemed to acquire that asset at the open market value. So if I were to, if David and I were in partnership and we transfer, operating through an LLP, and we transferred property into a limited company, let's say we bought the property for £50,000 and it's worth £1 million now. The company would acquire that property for £1 million. That will be its tax-based cost. So if thereafter the company decides to go off and sell that property for £1.1 million, the company has only made £100,000 of profit on which it's going to pay tax. So no is the answer, because in the way in which the rules specifically work with regards to the transfer of assets from an LLP to a limited company, either by way of a Section 162 incorporation or through the structure that we're talking about, there isn't a crystallisation of the gain. As David alluded to earlier, if you went through the Section 162 route, the gain, in my example, the difference between £50,000 and £1 million would sit in the shares in the limited company that we'd receive back for having transferred that property. So in the future, if David and I disposed of our shares, that would be when the gain would crystallise if we had gone down the Section 162 incorporation route. Using the other route that David's been talking about, that gain effectively gets rebased. So our shares also will have either a £1 million base cost, or will have a zero base cost on the shares, but £1 million owed to us by the company. So either way, the gain does not crystallise.
I think the important thing to mention again, although I did mention it in the webinar, was that for people that have incorporated already going down the 162 route, it is worth talking to us, because we might be able to help them move from that 162 position into our position, and it's worth having a conversation with us about that. So again, look forward to hearing from you.
Jim, the answer to that will be, it will be very much dependent on your circumstances as to whether you get Section 162 incorporation relief on transferring your properties to the limited company. So David referred to the Elizabeth Moyne Ramsey case. That's the test case that has shifted HMRC's position from previously saying, well, if a buy-to-let business transfers the business to a limited company, historically HMRC would have said capital gains tax needs to be paid on the inherent gain in those properties. So the answer is it depends on your circumstances, and also based on the scenario you pose. That's very much one that you should come to speak to David and I about, because there are other avenues that you may want to consider. I assume that question again relates to the Elizabeth Moyne Ramsey case, because with regards to the restructuring that we've been talking about, there is no such requirement In fact, we're not even relying upon the Elizabeth Moyne Ramsey case in the structure that we've been advising clients of. But in response to that question, Elizabeth Moyne Ramsey has basically set the bar with regards to incorporation of buy-to-let businesses. What HMRC will say is that that's the bare minimum you need to achieve in order for us to accept that the decision in Moyne Ramsey applies in your case. That doesn't mean to say another taxpayer couldn't go along and claim incorporation relief, but they could be in a position where HMRC challenges them, and they would have to go along to the first tier tribunal in order to argue the case as to why they should also qualify. Those that exceed the Elizabeth Moyne Ramsey test, I would expect that HMRC would be less likely to challenge that situation because they've already got a case that they've lost. And the answer is it depends on the terms and conditions of your mortgage. So if the terms and conditions of your mortgage provide that you have to advise them of a transfer in beneficial ownership, then the answer would be yes. We've looked at numerous mortgages over the years that we've been advising clients of. And so far, the only ones that we've come across in the buy-to-let space are capital home loans, where they've got a specific clause about you requiring consent. But also, if you do have a commercial mortgage, then you also need to be mindful that that's not in the same space as buy-to-let mortgages, and there's more than likely a clause in the terms and conditions requiring you to obtain lender's consent before you can transfer the beneficial interest in those properties.
It's important to say, Raj, at this juncture that with tax, it's the beneficial ownership that tax law follows. And from our planning, we can just move beneficial ownership into the LLP and then hopefully subsequently subject to into the limited company. But there's no reason on earth why we can't move beneficial interest and legal title into the LLP and through the structure at the other end. And in examples that I've cited before with Lloyds Bank, that's certainly one of their criteria, that they like to see legal ownership and beneficial title moving through the LLP and then ultimately out into the limited structure, and they're happy with that.
The difference is the legal standing of the two. So a normal partnership doesn't benefit from limited liability for a start. LLPs were first born in the UK back in 2001. And although the law surrounding them is very similar to a normal partnership, which is otherwise referred to as an 1890 partnership, because that's when partnerships were first recognised in the UK. So LLPs have the benefit of limited liability, but also they have their own distinct set of tax rules, albeit similar in some instances to those relating to 1890 partnerships.
Yes, I think if you remember in the webinar again, I refer to the fact that we do use limited liability partnerships. So if you are in a partnership at the moment, that's great. But we would be looking to move that partnership into a limited liability partnership to afford ourselves the opportunities that we get with our restructuring.
I think if a wealth tax is going to be introduced, it's probably going to apply to all assets owned by an individual in excess of a certain value. I'd expect that they'd have a de minimis where they don't really want to be involving, I guess, Joe Public. They'd be wanting to impose a wealth tax on probably those with assets of in excess of £1 million, thinking about the current residential nil rate band, for example. And I also suspect that they would introduce some reliefs surrounding business property, which again would mirror the types of reliefs available in respect of inheritance tax today. And so if you followed those current rules, I would suggest that a company that is in the business of letting property probably will not qualify for any reliefs against that wealth tax. So the answer would be yes, I'd expect a limited company or any other structure for that matter in which a buy-to-let business is operated to be subject to a wealth tax. However, with regards to a limited company, there would be potentially other ways in which you might mitigate some of that wealth tax by introducing business that does qualify.
I think the instance there is you need to talk to your advisors and preferably talk to us about this, because there are certain circumstances in which we would say if it's a brand new purchase and you're looking at doing it from scratch, there may well be good arguments to do it straight into a limited company. But there may also be benefits that you might get by buying it personally. I don't think we would, in any circumstance, we would really be advising to buy into an LLP, knowing that something might happen to that LLP in the future. But again, it all boils down to circumstances, and there may well be issues that need to be considered, which, and remember I said no two circumstances are the same. So I think take professional advice in relation to this from obviously property tax specialists that will be able to help you. Anything to add to that, Raj?
No, yeah, absolutely. You need to take bespoke advice relating to your personal circumstances. In some instances, it makes sense for individuals to own properties in their own right. In others, it makes sense for them to be purchased by a limited company. So it really depends on your personal circumstances. I would say that having less than 10 properties doesn't pose a massive risk, because historically there used to be a time when HMRC provided clearance in relation to incorporating your buy-to-let business. They stopped providing such clearances about 2 years ago, but we know from our experience that generally they found that 3 properties was the minimum for one to argue that they were operating a business. And that's the hurdle that you have to go through. One might argue that having one buy-to-let business, one buy-to-let property is an investment. Having 2, yeah, still possibly an investment, but going into 3+, there's far more involvement required of the individual. But it needs to be looked at on a case-by-case basis. So yes, it does mean that the person who's posed this question, if they have less than the 10 properties that were relevant in the Moyne Ramsey case, they're not just going to be able to use that trump card and say, hold on a second, we've got an upper tier tribunal decision in the case of Moyne Ramsey. She had 10 properties, I've got 15. She was working 20 hours a week, I'm working 30. You know, what sets out my position as being worse than Moyne Ramsey? And you'd find that HMRC will probably say, actually, we don't want to take this fight on. Where the Moyne Ramsey conditions aren't met, yes, HMRC are going to have more of an appetite to potentially argue that incorporation relief doesn't apply, but that doesn't mean to say that they're onto a winner.
I think, as you rightly said earlier, our planning is not around Section 162 or the Elizabeth Moyne Ramsey. So again, from our point of view, delighted to speak to anybody that's got 1, 2, 3, 10, 15, 20 or more properties, because we believe we will have a solution for you that'll help you.
With regards to transferring legal interest, I would wholly expect that in those circumstances, the business would have a fair amount of administration in order to transfer that business into a different operating medium. So you'd have to go about changing all your contracts. You'd go along to your lender. You'd be renegotiating your loans, possibly even having to rebroke them. You'd have a conveyance of your properties. So as David mentioned earlier, for tax purposes, the only thing that HMRC are interested in is the transfer of beneficial ownership. That's the tax point. So whether you transfer legal interest or not is actually not wholly relevant to the tax position. So what we've found in the past is that clients, in order to avoid a lot of the administration, have transferred beneficial ownership, and that ticks the box in terms of restructuring their business. So you don't have to go through all the hurdles required when transferring legal and beneficial ownership.
I think ultimately, at the end of the day, when everything is seen through and you've got to the end of the restructuring, you will be bringing legal title and beneficial title back together again. So you will ultimately end up with legal title and beneficial title in the ultimate entity that you're going to be in. And I think it's just, as Raj said, for ease, but also, just following tax laws and what issues you might face. And of course, there is this thing called cost. There may well be a cost involved in moving legal title and then moving it again. So we've found that we can get around that circumstance quite neatly and with some of our planning. And again, get in touch and we'll talk to you more about that.